Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of The Options Playbook, and I will be your host for about the next half hour here on Options Guy TV. So this week we're going to do a rinse and repeat of a strategy that has been working out on most Mondays. And what we've been doing with our iron condors that we've been looking at in the SPY is we started about 30 days ago. Well, I guess a little less than that. I guess it was about 30 days. We looked at an SPY iron condor trade that expired in November. And that trade started out about 40 days out. And that's a normal way that I would look at a rinse and repeat iron condor, trading about 40 to 45 days out, looking to close about 20 days in. We discussed that a lot last week, as we also went out and did an iron condor last week starting on a Monday. And that one, just to be a little bit different, we went a little shorter, and that expiration date was going to be on the 23rd. So that was going out a little bit over 2 weeks in time. And so this week I decided that I want to start off Options Guy TV for this week by looking at an iron condor, once again in the SPY. But we're going to do a very short-term iron condor. We're going to use the expiration date that is this Friday, 4 days away. So we're going to get some activity. Maybe we adjust the trade. The previous iron condors that we've looked at have been solid trades. The market has never came up and actually reached either the call short strike on the upside or came down and reached the put short strike on the downside. So without it ever getting to our risk area, there's really not been a need to adjust the trades whatsoever. So still kind of feel the same way about the market until that November 17th date, where Congress is supposed to come out and decide if they'll kick the can down the road again, or they'll fully fund the U.S. government, and there's no risk of a shutdown. That is a big day. And I do not think that the markets can really get ahead of that until we know that news. And it's out there. Everybody knows about it. Not to mention the fact we still don't have a Speaker of the House. So there's still some nervous news. If anything, I'm going to lean to the bear side. We got a solid update today. The VIX index is trading a little bit higher than it was at the beginning of October, but at the beginning of all of these budget negotiations, it's trading right in that range. We're at 1752 today. It did break through the 20% level in the VIX around the big date where we were talking about kicking the can down the road. And government actually did get something done and postponed the government shutdown or of certain areas of the government, I should say. And but the VIX is still showing that there's nervousness in the marketplace. And the fact that we're trading at 17.5, I do think that it could go higher. We're going to talk about a long straddle. We went into the painful details of it on Friday. Going into that news, if I can see the VIX come down to about the 16 level or so, let's say we have a couple of good up days, I think we're going to take that opportunity to buy a long straddle heading into the big news event. The volatility hasn't been pumped up yet. For some reason, people are choosing to ignore that, or ignoring that could happen, that the government could get shut down. And so I do want to do a long straddle paper trade going into that trade. But to start with, let's do one more short iron condor this week in the SPY. And then we'll come back on Wednesday and we'll try to add a stock to our portfolio. We'll talk about what's going on with our iron condor. And we'll look at buying a deep into money call on a stock that we might want to get long, but we're bullish but nervous on. And we'll sell a shorter term call against it, the good old fig leaf. And that's going to be the plan for Monday and Wednesday. Now, want to emphasize, if you have any questions and you are on the YouTube platform, you can put them in the chat box and we'll be happy to try to address them during the show. So feel free. We like this to be as interactive as possible. Share it with your friends. Let people know about Options Guy TV. We're trying to build this platform out, and I'm here and available to answer any questions that you have. They don't necessarily have to be on the stocks that we're looking at, but that kind of fits with the narrative that we have here on Options Guy TV. Okay, so SPY right now, 436.85. If you look at the chart, and I'll pull that up once again. Let me get there. Give me a second. As that's pulling up, I'll just say that if we're looking at the SPY and what it's done recently, you will see that we're kind of in the doldrums, and I think that's part of the reason the actual volatility of the marketplace is affecting where the VIX is at, because we really haven't had much actual volatility in the short term. So when we're looking at these portfolios and trying to decide what exact strategy we want to do on the shorter term basis, I just want to stick with what the chart is doing at that point in time. So 1 second here. I'm trying to get my TradeHawk software to show me that chart, but it's not coming up right at this second. So give me 2 more seconds here. Think I'm going to have to do the good old turn it off and turn it back on. All right. So in the Iron Condor, while I'm waiting, there we go. And we did move. Okay. So I'm going to stay right there. There we go. Now we can show what we got going on. So here is the congestion that we've had. So we had a big, strong upside candle. I wouldn't say strong, but we did bounce a little. Well, this is the VIX. That actually kind of looks like the SPX. All right. SPX, SPY. But we did have the big upside candle here, bounced about off the 4,200 level. That was an area of support. A lot of noise right around in this area. And now, since we've had those two strong days, actually, we're trading right in between the 50-day and the 20-day moving average. 1, 2, 3, 4, 5, about 7 days where we're still consolidating in that marketplace. And once again, it has a lot to do with the news. We've got a potential to gap up and a potential to gap down, trying to decide. And I think when we do break, we're going to break hard. And hence the reason why we've been talking about a long straddle in that market. Now, let me try this again. I'm going to go back to I don't know if that was worth looking at that chart, but now we have everything seems to be moving again. I'm back. Let's look at the SPY. We're going to go 4 days out to the October 20th expiration, which is going to be this Friday. So implied volatility in these option contracts is right around 17%. We see the VIX trading right at that level. We're going to go approximately a 1 standard deviation move. We have plenty of strikes in these nearer term expirations because they're considered quote unquote weekly expirations. And they usually have 1 point strikes. We ran into a situation with one of our Iron Condors where we went out and we had 10 point strikes. That's all that we could come up with. But I'm not too concerned about that here. I'm going to start by looking at the call side of our Iron Condor. This means that we're going to be combining a short call spread with a short put spread, hoping that the market will stay between the sold call strike and the sold put strike. And we'll look at it inside the what if calculator. But at this point, we're selling I really want to sell the 446 strike call right now, but I'm not bringing enough premium to make me feel okay with that. So I'm going to go to the 445. Now the 446 is, well, we're right about a 1 standard deviation. So 16% delta should be right around a 1 standard deviation move. The software is showing that it's between 445 and 446. So we're going to sell this option contract, bring in a decent amount of premium, which is 61 cents. And then we're going to go down and we're going to buy the 450. So we're going 5 points wide, and that's going to be our protection. So now we're getting that done for about 50 cents. And when we went out and did our Iron Condor that expired in November, that was over 40 days out in time, we also brought in about 50 cents on our call side of things. So just to compare apples to apples, we're at 436 right now. We got 9 points before we get to our area of risk, to the line of gain, if you will, if you're talking football. But 445 is where the issue is if the market comes up to that level. Now we're going to go down to the opposite side. It's a little bit harder to get done for the credit that you would like on the downside. So I'm not anticipating that we're going to get exactly 50 cents if we go one standard deviation out of the money. And here's the reason why. As you go further out of money on the put side of things, the implied volatilities will increase, meaning that your hedge, your leg that protects you, will be trading at a higher volatility than the leg that you have sold to try to bring in the income. And you can see that. I'm going to highlight over here on the right side of the Trade Hawk options grid chain. We're going to highlight that we have the implied volatilities right at 48 to 428. We're seeing that trading at a delta of around 19 on that one. So right here is about where we want to be, right around that 15, 16 delta. It's trading 85 cents by 84 cents, really tight market. But you see, as you go deeper into money, we're at 17 vol. We go a couple of points down, we're at 18 vol. A couple of points down, we're at 19 vol. So you're gradually increasing in implied volatility. And that usually that happens mainly because when you're looking at the SPY and the SPX index, you're usually going to get a lot of volume in the out of the money puts because they're used more so for protection than for speculation. So people are buying these puts to help protect their portfolio. And if you've traded long enough in the markets, you usually know that markets have a tendency to go down a lot faster than go up. So people are willing to pay up for some out of the money puts, the cheaper puts, the lower deductible insurance contracts, right? So this is a normal situation. Harder to get this put side done 5 points wide for about the same amount as the call side. So we're going to sell the 426 call or put, 82 cents. And then we'll go down to the 421 and we'll buy that's 5 points. And we'll buy that. And that one's going to be done 85, about 40 some cents. Not too bad. Net credit here is at the midpoint of 85 cents. So that's 5 points wide, and that's 5 points wide. And this is our iron condor for the week. We're going to have something happen to this. It's a very touchy iron condor in that we have a very short-term expiration. And if I'm doing iron condors as a staple in the portfolio, I'll usually go out longer in time. Put on the trade, look to start at 40 to 45 days, close the position out at about 20 to 25 days, depending on obviously where the market is at. If you got to adjust it, you can. Part of that reason why I like to approach a longer term strategy when I'm seeing the markets being more neutral, using longer term option contracts, is that if the market goes against you, you have something to trade. If you're in the short-term options and the premium dries up as the market goes against you, it's very hard to adjust that position because there's no premium to protect you on the option contracts that you bought for protection. Everything's just going to start to dry up in the shorter-term options. But it's sometimes you want to do these type of trades. Sometimes you want to just do a shorter term speculative trade that is that you might not be looking to adjust. So here's how I'm going to approach the shorter term trade, in that if the move goes against us, either on the put side or on the call side, and it happens right away, I may consider an adjustment. But more than likely, if it goes against me, I just want to trade out of it. I think the markets are going to stay neutral, but if it came down and hit my short strike on the put side or on the call side, I'm going to close out that trade. That's going to be the most likely scenario on this. If I could see an adjustment, we'll do that. But at this point in time, that's probably the trade that we're going to do. Now, the adjustment, you could roll it down. You could actually just take off one side of things if you want to look at where the market is at as far as the chart is concerned. If one trade it's going against you, you can play the hope game, close out the other side, let the side that's going against you run. So, and hope for a bounce back. And that's the way that we can approach this position. So I'd like to do the shorter term iron condor as always here on Options Guide TV. It's not meant to be a recommendation, but we're going to look at if we can get an adjustment of this trade and see where we're at on Wednesday and see how we want to play this trade, if you will. All right. So let's go to the what if calculator. This is going to be the official paper trade for the day. Let me pull up. So at this point in time, let's jump back out and see if we do the transfer just fine. Okay. All right. So now we're back. Let's look at the what if calculator here on the TradeHawk software. Very straightforward, very simple. Real short-term trade. This is where our risk kicks in. Right at the short strike of the put at 426 on the downside right here, and it's showing us that. On the call side, the strike that hurts us the most is the 445. So from that point on, this is where our risk is at. Our sweet spot is going to be between 445 and 426. So we have a nice, decent range. We got the VIX up a little bit. We're elevated at right around 17.5% implied volatility, and I will make a note on that. We do have an up market. If we do get the VIX to come off a little bit, the market kind of stays where it's at or continues to drift a little bit higher. Implied volatilities could come off, and that would help this trade. So that's a couple of things that we wouldn't mind seeing on the trade. And as expiration approaches, so right now we see our profit and loss is the green line. As it approaches, as expiration approaches, that will slowly start moving up, and it will look like the graph at the expiration date. So that's where we're at. That's going to be the official paper trade for this week. All right. So if you have any questions, feel free to put them in the chat box. If not, I'm going to go back and we're going to look at the Google trade that we talked about last week. So on Wednesdays, we've now decided that we're going to build a portfolio of deep in the money option contracts. And it is a little bit more of a neutral strategy, but it's going to be neutral to bullish. Right now, the good old iron condor is definitely neutral. We want the market to stay right where it's at. And so far, the last two iron condors that we've looked at, the market has done as we would like and stayed within that range, right around the $436 range in the SPY. That's where we're at. And now if we look at Google, which is also known as Alphabet, when we went and put on the trade last week, we bought the 105 call on the underlying. The market was trading at 140. We now see that the market has came down and we're at 138.61, and we sold the 150 call against it. Today's date is the 16th. The one that we sold is on the 27th. That was that expiration date. So of October. So here's where our call option was that we sold against our position, and we sold the 150 strike call. So I'd like to take a peek at that, and let's clear this out. And we'll go and look at the 150 here. So we sold this option contract for $1. It's now trading at 47 cents, which also means that the one that we bought that was much deeper in the money, and we're going to go out to that expiration, it's a much different date, will also be hurting on our position. So when we put the whole trade on, it was trading right around 46.25. We're at 50 cents on this. I'd just let this ride. It's doing its job. It's helping us out. We've sold it for $1. It's trading for around 50 cents. If this got down to closer to 10 or 15 cents, and let's say it happened in the short term, I would consider rolling this. And I might even roll it scenario. So go out maybe another week, go down in strike, try to bring in some income above and beyond the last 10 or 15 cents. But it looks like for that option to trade, it's got to move almost another 5 points to get down to 15 cents right now. And all I'm doing is using what the real live markets are trading for. We're at 150 is that strike. For this to be 5 more points out of the money means the market would go down 5 points and it would be trading right about where the 155 is trading right now, which is 5 points higher than where the strike is at. So, and that's trading for 14 by 16 cents. That's the range where I don't mind rolling my call position. When I have a fig leaf on, otherwise known as a leveraged covered call, I am going to actively adjust the short call. I don't want to be assigned, but I do want to bring in premium. Right now, we still got some decent amount of time value that could decay in this option contract, so I'm going to leave it be. But if it does come within a range, I am going to go down and trade that and roll that position. And it looks like right now, based off of the real market, it would have to move about another 5 points in the wrong direction in order for me to want to go out and roll that call option. That expiration date is on the 27th, and we have the 27th. Okay, so now let's see where our position is at. I'm not nervous about the position. We're going out way long in time. Our expiration date is in January of 2025. So I got to go all the way down to the end. A lot of these expiration dates, January of 2025. Okay, that's the right one, January 17th. Now, the call option that we bought was the 105 strike call, and that is now trading at 45.75. So it's a little bit down on that situation, on our situation. So right now we are down $2 on the trade. So we put this entire gaggle of securities on. Let me grab a little bit of water. This entire gaggle of securities, of option contracts on for 46.25. Good thing we sold the call against it, and that's part of the rationale why we would sell a call. We're bullish but nervous on the marketplace, trying to start to take a position in some stocks that we might want to own in our portfolio, and we're going to do it by buying deep into money call options. So if I look at this trade, everything's looking solid. I don't want to sell the 150 strike call yet. I don't want to close it out. I don't want to roll it. So on Wednesday, we'll come back in and we will look at another stock that we might want to add to our portfolio going into November. All right. I do see we have a question here. Oh, we just have a comment, I guess. So thank you, Jan, for giving us, or for chiming in. Please share with your friends. Please click subscribe. Please ring the bell, and please give us a thumbs up. So this is going to be it for this Monday edition of Options Guy TV. We'll be back on Wednesday at 11 a.m. Eastern time to look at adding another deep in the money option contract into our paper trade portfolio. Thanks for coming, everyone, and we'll see you this Wednesday.